It is definitely happening again, and you're probably wondering, like, what the heck is about to happen, Brandon? Well, take a look at this chart. The blue line corresponds to the cycle of the market that we're in right now, and the red line corresponds to the cycle of the market that is about to just get started right now. You can see red line and blue line are pretty much overlapped in this period through here, but then all of a sudden the red line has massive astronomical growth going all the way up to roughly 1200% gain in that cycle, and right now we're only at a 400% gain. So about 800% more of a return could be coming in this market, and in this video, I'm going to explain to you exactly why. So I've seen this story time and time again, and I've been doing this for decades, and I'm going to be completely honest with you. The setup right now, I've never seen before, and I've never been more bullish in the market than I am right now. So everybody was panicking at the beginning of this year because Trump put on tariffs, and everybody was just freaking out that we're going to go into a full-blown recession, a depression. We're going to have stagflation where the economy takes a crap and then inflation goes way up. That's going to put the Federal Reserve in a very, very tricky spot. And no one really knew what was going to happen with this trade war that was potentially going to happen with China. It's like, if we go into this trade war, how could we ever come out of this okay? How are these companies going to actually survive and be very profitable going forward? Because it's like Trump said we're going to make an iPhone in America. We're never going to make an iPhone in America. And if we do, it's going to be thousands of dollars. How is anybody going to afford that? So everybody was freaking out and they were panicking. And that sent the NASDAQ down over 22% in just a month. 1 month, the market went all the way down 22%. But now the market's rebounding very sharply. It's up roughly 20% from the low. And everybody wants to know, are the storm clouds gone? And am I too late to buy into the market right now? The answer is 100% definitively no. You are not too late to buy into the market right now. And by the end of this video, you're going to know exactly what's going on in the market, the state of the market, and exactly how to capitalize. No BS, no fluff. I'm going to show you into my $1 million account to show you the trades that I have right now so that you could potentially capitalize on those trades too. Because trust me, we're on the brink of a massive shift in the economy that if you understand it and you know how to capitalize on it right now, you could build generational wealth. So going back to 1980, and this was the first chart that I showed you guys, and this chart is critical to understand. From 1980 to 20 years later, so that would be the year 2000, the stock market went up over 1,200% in that time period right there. Right now, we're only up 400%, and the similarities are honestly extremely striking right now, but there's one key difference. So in this period from here to here, inflation was going down, and interest rates were also going down too. Remember how I talk about it all the time. As inflation falls, that gives the Federal Reserve more leeway to cut interest rates. And what happens when we cut interest rates? Usually stock prices will go up. But what happened in this period on the red chart where the growth accelerated like crazy going into 1999? And you probably guessed it right. It was the beginning of the dot-com era. Anything with a dot-com behind a name, the share price went pretty much straight up. But there's critical differences right now in the economy and the stock market versus what happened in 1999 and 2000. You could see what happened. The stock market went pretty much straight down. So maybe we get this massive pump, but then maybe we get this massive dump. But the key difference right now is that the vast majority of the companies in the NASDAQ that fueled this rally right here, they weren't actually profitable. It was all on the hope that one day they would be profitable, but they actually weren't. And the difference to the stock market right now is that the companies are extremely profitable right now, and we're on the brink of this massive AI revolution that's about to make so many companies more profitable and more efficient. So this pump right here from 400% to 1200%, this might look like peanuts when we actually realize the true gains of AI and how it makes our life so much better and so much more efficient, and these companies are going to print money like crazy. And it's already starting right now. You guys know the number one thing that moves the price of a stock in the long run is what their earnings per share does. The earnings per share is just a profit. So let's take a look at NVIDIA. For Q1 of 2024, they had about 10 cents per share earnings per share. But right now, if we go all the way up, it went from 10 cents to now 89 cents per share. You can see the earnings per share growth is pretty much straight up. You could see what the stock did in that same time period. It went from roughly $8 per share to now $123 per share. So this move was justified because the earnings went way up. Let's look at another one. Take a look at TSM. Everybody here knows what NVIDIA does. Everybody knows what TSM does. TSM makes the chips. NVIDIA designs the chips. So take a look at TSM. Their earnings were 96 cents per share. Now they're at $2.12 per share. And keep in mind, this is only a 4-year change rate here, so the earnings are going up like crazy. And guess what happened to the share price? It went from 50 bucks a share all the way to 186 bucks per share. I'm going to show you two more. Let's look at Meta. Meta was doing $3.30 per share. Now we're all the way at $6.43, so roughly a double in earnings per share. Guess what the stock price did? Went from roughly 230 bucks to now 639. One more, let's do Google. $1.31 per share, and now it's at $2.81 per share. Google is printing money right now, and guess what the share price did? 70 cents to 159, so over a double in the share price. So the reason why I'm showing you all this stuff right now is because we're at the beginning of this massive cycle where these companies are implementing AI into their businesses, and AI is coming in a way that we don't even know what the next few years are going to look like. But there is one thing that I could promise you, and it's that the future is going to look a lot different than it's going to look right now. A lot of companies are going to win, a lot of companies are going to lose. So the key is to find the companies that are going to win and to stay away from the companies that are going to lose. So that's what we're going to go through right now. So there's going to be a certain type of tech company and AI company that's going to fuel the stock market to go from this growth rate right here to this accelerated growth rate right here. There's only going to be a few select type of companies that are going to do this, but if you know where to look, you're going to know where to find them. So let's go into that. So I'm going to keep this very simple for you guys, and I'm going to show you into my stock sheet, which I have this on course members only Discord. And if you want to join, click the link below. You get my course and my full access to my Discord for 29 bucks per month. And this comes included with it. This is honestly just a very small percent of what I do in Discord, but it is very, very helpful to see what's going on in here. So I have 8 companies and 2 ETFs that if you want to buy right now, you're probably going to absolutely dominate the market. And then I have 3 stocks on this list that you should absolutely not buy right now. And if you buy them, you're probably going to fall into the trap and you're probably going to lose a lot of money. And I promise you, these 3 stocks, there's a lot of hype behind them and everybody knows the name. You're going to know every single stock I'm going to talk about here, but the 3 stocks, you're definitely going to want to stay away from those. So the bullish stocks, and I'll go through these real quick. I'll talk for each one for maybe like 15 seconds. AMD is very bullish for me. I feel like it's trading below intrinsic value. And if we highlight that column, the intrinsic value is 114 bucks per share. It's currently at $108 per share. So it's trading at 94% of the intrinsic value, basically meaning that it's at a 6% discount. Amazon's another really good one, but honestly, it's a little bit overvalued in my opinion because I have the intrinsic value is 192 bucks per share and the current price is 208. So it's roughly 8% expensive. And you're probably wondering, how am I getting these exact intrinsic value factors right here, which is like the true value of the stock? I have a calculator that I built, and it's the one calculator that Warren Buffett himself uses and Benjamin Graham, and I modified it a little bit to give us very precise figures for what I feel like these stocks are truly worth right now, to know if we should buy calls or sell puts or do whatever option trading strategy on them. And then we rank them by our favorite stocks and our least favorite stocks. And our favorite stocks, we go bullish on them, and the least favorite stocks, we go bearish on them. And we've been doing very, very well in this market. Broadcom's another really good one, AVGO, but you could see it's still a little bit expensive. Intrinsic value is 193, and the current price is 221. So it's roughly 14% overvalued. But you got to understand, when you plan to hold on to these companies for the long run and you're only paying a little bit over intrinsic value, the longer you hold, the safer that it's going to become, because the earnings per share of these companies are going to go way up in the long run because they have pricing power, they have a moat, they have a durable competitive advantage. These companies are just pushing us into the future. They're going to do much, much better as time goes on. Another one that I like a lot is Meta. Meta's trading at 94% of intrinsic value, basically meaning it's 6% below intrinsic value. So Meta is a buy. Again, they have a moat. They don't have a lot of competition. They are printing money like crazy with their ad machine. I really like Meta a lot. MU is Micron, and they basically make the memory portion of the data centers for all these big companies like NVIDIA and AMD. So you can't really get a data center or an AI setup without Micron. So Micron right now is trading at about 107% of intrinsic value, meaning it's a little bit expensive. But again, if you plan to hold these stocks for the long run and you sell longer duration puts, you will most likely do very, very well. And you probably knew that NVIDIA was going to pop up on my list, but again, a little bit expensive right now. But as these companies start to grow and their profitability goes up, the earnings per share goes up, these numbers are probably going to come back into range right here, meaning it's going to probably get cheap again because we will see volatility in the market. The market's been ripping pretty much straight up lately, and that's why things are a little bit expensive, but the market will take a breather, things will come down a little bit, and that will give us a better entry into the market. Now, an ETF that I'm bullish on right now is Triple Q. The current intrinsic value of Triple Q is $442 per share, and it's currently at 507 right now. So you're going to be like, Brandon, what the heck? It's 14% overvalued. How are you bullish on it? Yes, it is a little bit expensive right now, but if you hold this for the long run, you're going to wish that you paid 507 for it if you plan to hold it for years going into the future, because this is going to be much, much, much higher, I promise you. And you probably guessed that Tesla was going to end up on this list, and of course it is, but take a look at the intrinsic value. $135 is my intrinsic value for Tesla, and it's currently trading at 318. So Tesla is a little bit expensive right now. I mean, it's quite a bit expensive, but I feel like the earnings of Tesla is going to start to explode in the years going forward if they truly capitalize on Optimus and the Robotaxi network. So that's why you could see right here, it's quite a bit overvalued, but Tesla's honestly a very, very hard one to value because there's so much potential growth coming to the company that it's very hard to pinpoint exact numbers for that one. And again, another ETF, if you just want to play it safe, buy into VOO, that's the S&P 500. It's roughly 10% overvalued right now. But if you hold that for the long run, these tech companies are going to push us into the next wave of growth, and you will do very, very well. Now, flipping over to the bearish side, I have 5 companies for you. I added on a couple more because there are some stocks here that a lot of people love to buy, but I promise you, they're expensive. They don't have pricing power. They don't have a moat. And if you YOLO into these stocks, you're probably going to get crushed. So number 1 is ASML. And just so you know, these are not in any specific order. These are just 5 companies that a lot of people love, but I promise you that you're probably going to get smoked if you buy into them. ASML is basically the company that builds the machines that actually fabricate the chips. So ASML sells these machines to TSM, and then TSM uses these machines to build the chips. But there's a lot of competitors emerging into the field, and TSM is working on their own machines to build their own chips to save money. So ASML is a value trap, and of course, it's 36% overvalued. I would not want to buy into ASML right now. Number 2 is Coinbase, and honestly, I hate Coinbase because there's so many other companies out there like Robinhood that are doing zero commission trading on crypto. And it's like, how do you compete with that if you're Coinbase? Coinbase has high fees. It feels like their app is always down when there's a lot of volatility. And Robinhood is just running business as usual. So I feel like Coinbase is going to continue to have margin compression because they're not really doing any innovation over there at Coinbase. People are going to move over to Robinhood when they have these issues. So Coinbase is not good, and it's 31% overvalued. Let's move down. Palantir, honestly, if I have one number 1 on this list that is very, very bad and it's extremely overvalued, it's going to be Palantir. 462% of intrinsic value. The intrinsic value is $25 per share. Currently trading at 118. It's absolutely freaking nuts. Palantir is out of control, and you got to listen to their earnings calls and you got to read their earnings reports. They're only growing revenue at 39% year over year, but they're trading for a PE ratio of over 300. How do you justify a PE ratio of over 300 if you're only growing revenue at 39%? Astronomically high. I recommend to stay away. PayPal is another one. It's only 6% overvalued, but I consider this to potentially be a value trap, is what most people will say, because PayPal has absolutely no moat. They have no pricing power, and they have a lot of competition. I recommend to stay away from that. And we're going to wrap this one up on SoFi. SoFi is a very hot stock that a lot of people like to buy into, but it's trading at 48% above intrinsic value. Current share price is $14 and the intrinsic value is $9. So very overexpensive on SoFi. And a lot of people say, well, SoFi is growing like crazy. Yes, I get it. SoFi is growing like crazy, but if I scroll up a little bit, this 50 rate here, this corresponds to the growth rate that I'm assigning to SoFi, assuming that it's going to grow at 50% for the next 5 years in a row. So 50, 50, 50, 50, 50 for 5 years in a row. So I am giving them the benefit of the doubt and saying 50% for the next 5 years in a row. But honestly, I just don't think that's going to materialize because they have a lot of competition and they're advertising a lot. And when you have to advertise that much to bring in new customers, maybe your platform is not as good as what people actually think. They're direct competitors with all the big banks. SoFi's PE ratio is roughly 100. And just for reference, Chase Bank and Bank of America, their PE ratios are right there around 17. So 17 versus 100. And they're not really growing that much faster from a revenue standpoint versus the mainstream banks. I think that SoFi is very, very overvalued. So I recommend to stay away. And keep in mind, the stock sheet is only updated at the time of this video. It changes all the time in real time, all throughout the day. I change the growth rates. I have trades that I do below this stuff. There's a lot more value on the stock sheet than what I just showed you. But remember, we're on the brink of a massive tech and AI revolution. The key is to capitalize right now and to learn how to do it the right way. If you're interested, click the link below, do my course, come into Discord. Everything is $29 a month. One membership gets you everything. It'll blow your mind. See you guys there.